makers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London, in for Francine Lacqua. President Trump then says he will not fire Fed Chair Jerome Powell after making a rare visit to the central bank, the first by a sitting president in nearly 20 years. The pair publicly clashed over cost overruns during a tour of the Fed's renovation project.
It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1,
3.2.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
There's a lot you can read into that. That is going to be great fodder, though, for the late night shows, isn't it, in the US? Let's bring in Bloomberg's Valerie Teitel right now. The physical presence of President Trump being in the building with Jay Powell, standing alongside him, having that awkward exchange. There is a monetary policy implication to this.
Well, I mean, not only was he criticizing Jerome Powell on the cost overruns of the Federal Reserve renovations, but he went on to basically pressure the Fed chair right in front of the cameras in the Fed building to cut interest rates at the next decision. And after so, Tom slapped him on the back and walked away. So it goes to show that even though Trump says there is no tension between the two, it is clear that President Trump is trying to amp up the pressure on Fed Chair Jerome Powell to lower interest rates, saying at one time that I want to see just one thing happen. It's very simple. Interest rates have to come down. So an extraordinary sight to see one of a U.S. president pressuring the Fed chair in the Fed building in front of televised cameras.
Not a scene we get to see every day. Meanwhile, U.S. equity markets notching a fresh record high. We've said that a number of times this week, 10 times in the last 19 days. What is the next catalyst for these markets? Are things looking a little overstretched at this point, Val?
Well, before people would say it was going to be the earnings season that was going to be a catalyst for the equity market, and it's turned out quite okay. The S&P 500 index has notched a record high every single day this week, and with futures pointing in the green, we look to make it maybe 5 in a row. This coincides, Tom, with the VIX, the kind of Wall Street fear gauge, the implied volatility gauge, dropping to a 5-month low. And if you actually look at NASDAQ 10-day historical volatility, it's dropped to a 4-year low, Tom. So this decline of volatility, almost like markets are getting used to this kind of political show from President Donald Trump, not fearing necessarily tariff headlines anymore, is something that's really been opening the door for more gains in the equity markets to come. It was helped out yesterday as well by the fact we did have jobless claims coming in, declining for a 6 weeks in a row, hitting a low they've not seen since early April. So this kind of idea that we're getting used to volatility, we're getting used to what's coming out of the Trump administration, alongside still good news that the U.S. economy is humming along, is helping the U.S. equity market notch another record.
Valerie Teitel, thank you very much indeed. Let's bring in another perspective on these markets right now. Angel Ubide, who's head of economic research for global fixed income and macro at Citadel. Angel, good morning.
Good morning.
Thank you for joining us in the studio. I want to start then with the Fed. The markets are repricing around possibly fewer than 2 cuts from this Federal Reserve. And Valerie was talking about the relative strength of the labour market. And there's a clear tension now in terms of the data that we're seeing out of the US and the perspective of the US president. How are you factoring in? How are you starting to push out your views around the Fed and what to expect towards the end of this year?
Listen, I think the Fed will do what it needs to do, regardless of all this political pressure. Inflation has been well behaved, and so it might be able to take some insurance against a deterioration in the labor market. And that's what the markets are expecting.
When does that insurance come through?
Whether it's 1 cut or 2 cuts, it doesn't really matter, right? What it's going to do is put the economy in the right footing, and we think, at some point, if the next couple of inflation numbers are good, they might be able to cut rates in September, and that's fine.
Okay. Do you worry about Fed independence?
I don't worry about Fed independence in the sense the Fed is a very strong institution, right? This is not just about the Fed chair. It's a very strong institution. Now, it is important that it remains independent. It's important that it remains independent for monetary policy. And I hope and expect that this will continue to be the case.
In terms of your wheelhouse, when it comes to fixed income, the Treasury markets have been relatively well behaved in the last week or so.
Yep.
Yields have been relatively contained. There's been a little bit of upside pressure, a little bit of selling, but nothing dramatic. Is that the picture that continues through this year? As you look at the curve, do you see further steepening?
Listen, it's all going to depend on the behavior of inflation, right? So far, we've seen a little bit of pass-through from tariffs that has been offset by some softness on services and in other parts of the CPI. If this continues, fixed income markets will probably continue to be reasonably well behaved. A little bit of a steepening if the Fed cuts rates, but that's about it. But there is uncertainty. We continue to have all these trade deals that are coming. We don't know how they are going to look like at the end of the day. There is a little bit of risk in the long end of the curve, definitely.
What would a 15% tariff deal between Europe and the US do to that view?
Listen, a 50% tariff deal basically means that trade shuts down.
15% tariff deal?
Oh, 15, 1
15.
5. No, 1 5 is fine.
Yeah,
1 5 is fine.
As in, if we get a kind of Japan-style deal between Europe and the US?
I think that would be as expected, and we would expect a continuation of this environment where the tail risk has been cut.
Yeah.
And then markets and companies start making their own plans about this new environment with this level of tariffs.
Europe's economy, the ECB, was that a hawkish hold from Christine Lagarde and the ECB?
Listen, it was the first hold in a series of meetings. So I think we need to understand it in that way. So what Christine Lagarde said, today we are on hold, we are watching and waiting, let's see what we do at the next meeting. It was the right explanation for what they did yesterday.
Are there deflationary risks for Europe, given the strength of the euro?
I think there is a risk that inflation undershoots the target in a persistent manner. Whether that is a persistent deflationary risk over the next 2 or 3 years remains to be seen. It is a risk, and they should take insurance against that.
And given the fiscal stimulus that's coming through in defence spend from Germany, given the strength of the euro and the trade flows, and if we get a trade deal with US, do you start to think about an ECB that is hiking in 2026?
I don't know if hiking is the right concept, but they could stay on hold for an extended period of time while they see how events unfold. And again, they have an inflation forecast that is going to be under 2% for the next 18 months, right? Yeah. They need to be a little bit careful about that.
You put out a note talking about the need for Eurobonds in Europe. I don't know if we have the political consensus for that right now, but what is the case for Eurobonds as Europe faces up to some of these challenges?
Listen, the case, I think, is threefold. If Europe wants to have a strategic autonomy, it needs to have a strong financial market in addition to a strong security and defense. And you cannot have a strong financial market without a strong safe asset. Just imagine the United States without treasuries. This is what Europe is today. The second point, there is a strong demand for European assets around the world. We have this new environment, geopolitical environment, where global investors want to rebalance their portfolios away from U.S. assets. They want an alternative. Europe should offer that alternative, and that alternative is a Eurobond. And the third point, you may have noticed, the ECB has shifted this stance about the international role of the euro. It used to be neutral about it, neither promote nor discourage. Now it's actively promoted it. Christine Lagarde gave a very good speech in Berlin a couple of months ago, where she laid out the case for a strong international role of the euro. That requires having Eurobonds. Otherwise, the euro is not going to be an international currency because there isn't a clear asset into which investors can invest.
Don't you just buy the German Bund in that
It's
scenario?
too small. It's too small. It's just 4 trillion euros.
Yeah.
You need something that is big, that shares the benefits of a safe asset across all European assets. And that's what Eurobonds would do. And we have them. The EU bonds and bills that were issued to finance the next generation EU already exist. They have an infrastructure, they have a futures market, they are accepted in repo. Next year, the EU bonds are going to be the biggest issuer in Europe in terms of flows.
Yes.
So they just exist.
To finance defense spend.
Well, to finance everything, to finance, the current operations of next generation EU. What we need to do now is to come to an agreement that having a strong, big, deep and liquid safe asset is good for Europe. Go ahead and do it.
Do you have a view on the gilt markets here in the UK as we think about October and the strains on this Chancellor?
Listen, the gilt market still has a little bit of risk premium, right? Whether it's deserved or not is a different conversation. There is a little bit of risk premium. Inflation is higher in the UK than in other areas. That is true. And there are question marks about the stability of public finances. So that's what we have. And as we go into October, we'll be watching very carefully what the next steps coming from fiscal policy.
How on edge, given that risk premium that is still priced into the gilt markets, how on edge is the market as we lead up to that event? How finely balanced is this?
Listen, it's finely balanced, but also I want to insist, it's not just the state of public finances, it's also the behavior of inflation. We have a central bank, the Bank of England, that is still have rates reasonably high, and it's still cutting rates reasonably slowly. So there is a combination of those two factors, the worry about the inflation outlook and the worry about the public finances.
A more challenging situation, arguably, for the BOE than the ECB.
Indeed.
Angel Ubide, Head of Economic Research for Global Fixed Income and Macro at Citadel. Thank you very much indeed for those views. That analysis going from, of course, the ECB to the Fed all the way back here to the UK. Coming up, Europe's biggest car maker cuts its outlook as US tariffs eat into sales, talking of tariffs and trade, but German business confidence rises. More on that next. This is Bloomberg. Welcome back. Volkswagen shares are up, despite it cutting its outlook for the year. Europe's biggest car maker says US tariffs are weighing on its Audi and Porsche brands.
We made 6 to 8% margin, and currently we are faced with 25% tariffs. So this is clear we need a good solution, and a solution that fits both the needs of the American administration, but also the European automakers.
The VW CFO, Arno Antlitz, speaking to Bloomberg's Guy Johnson, who is, of course, on the ground for us at Wolfsburg. What do you make of the shares rising, Guy, and what else the CFO had to say about the challenges going forward for VW?
The challenge is unknown at this point. That is the issue, Tom. And in some ways, actually, Volkswagen is guiding us to a deal that looks very similar to what Toyota got as a result of the Japanese negotiation only a few days ago, 15%. They've given us a range. It's basically 10% up to around 27.5%. Basically, you back out the current 2.5%, you get to a 25% range, 25% level. Basically, the midpoint of that is, let's call it circa 15%. And it's interesting, Oliver Blum, the CEO, was on the call earlier on, basically pointing us in that direction as well. And it seems as if the business is basically saying we could probably manage that, and that seems to be the tone at the moment. So in some ways, we are getting some quantification, some quantifying of what the hit is likely to be, because they're basically guiding at the top end of the range. There's a 200 basis point margin hit. And at the moment, actually, it's weird. Companies are being given a pat on the back by the market if they can give the market something in terms of detail surrounding what the tariff impact is going to be. Companies that can't, and we saw that only a few days ago. Texas Instruments was a company like that, GM to a certain extent as well. If you can't quantify it, you take a hit. Volkswagen has had a stab this morning at trying to quantify what the hit is going to be as a result of tariffs, and the extension beyond that being kind of what kind of investment we might have to see in the United States. And I think to a certain extent the market's going, okay, that's fine. We know there's going to be hits. You're giving us some clarity on what we can do on a kind of sequential basis around this. And as a result of which we can maybe take some of the risk off the table. And that, I think, is probably the reason, Tom, why the shares are picking up a little bit. The market can kind of work with this and understand it. You don't have to price in the worst case scenario because the company's giving you something at least to work off in terms of being able to plug into your models.
Yeah, and the CFO, of course, talking to you and saying, look, we're trying to be as transparent as possible, giving that range to you, giving that range to investors. And to your point, the market seems to be rewarding that now with the stock up a little over 3%. When it comes to the Chinese market, Guy, it was interesting. We were speaking to Horst Schneider, the autos analyst. He was saying when it comes to Tesla, VW is probably best placed to take market share from Tesla. When it comes to China for VW, what is the picture there?
So I asked him at the end of the interview, he didn't play that sound a little bit earlier on today about China, and I said, look, Arno, the message seems to be coming from Beijing that actually the competition, the fierce competition that we are seeing in China needs to come to an end. And that certainly seems to be the message coming out of Beijing, this overcapacity, this brutal price war. And he was like, yeah, I think that probably is the case. That's the message that we're getting as well. And I think, again, that should be taken as a positive. It's been absolutely brutal in China, which has been in the past a key market for Volkswagen. And even at the margin, whether if that price war starts to abate a little bit, if it starts to just become a little bit easier to navigate and understand, then again, that's just kind of at the margin, as I say, a piece of good news for Volkswagen this morning. The other thing to remember as well is that here in Europe, they're actually doing okay. Actually, the turnaround in the core brands like Volkswagen and Skoda are actually doing all right. Normally, Tom, this factory behind me wouldn't be working during the summer, but actually the demand for the products that they're selling on the line, that's the Tiguan line here, is actually fairly good. So there are positives from what we've had out of Volkswagen this morning, despite the fact we've had this margin guidance cut.
Yeah, glimmers of light, maybe. Looping back to the trade piece, Guy, to what extent are they prepared to ramp up investments in the US, given the pressure from the Trump administration, given that pressure in terms of a trade deal? Are they prepared to put more money to play?
Yeah. I think they're going to have to, Tom. And I think there's a recognition of that. They just don't know yet what that number looks like. I spoke to Anna about this, and you heard it in the tape a little bit earlier on, who played on opening trade. I pushed him a couple of times on it, and the answer is, we don't know yet. They're not there yet in terms of figuring all of that out and getting an idea of how much they're going to have to invest. Now, Toyota, their big kind of global competition, has invested a lot of money, north of 60 billion into the United States. Volkswagen's nowhere near that at this point and will probably have to push, therefore, fairly hard. Now, they're doing a bunch of things. They are investing. Remember, they bought a stake in Rivian, so it's going to be interesting to see what they do with that and how maybe they put more money into that, maybe they buy that. I'm just speculating here, I don't know. But you've also got this new product coming through, which is going to be the Scout, which is a kind of storied brand in the United States, which has got a lot of history there, and they're hoping that that's going to take off as well. Now, that was going to be an electric vehicle, but they're going to add a range extender to that, just to give it, I think, a bit more breadth in terms of the offering that we are likely to see. But I think without a doubt, Tom, there is going to have to be more investment in the United States, particularly with Porsche and Audi struggling in the way that they are at the moment with the tariffs. Those are the two brands that are most exposed. Tom, from the factory here in Volkswagen,
Johnson.
What a fantastic scene, as you say it is. Back to you.
Yeah, love the backdrop. Great stuff. Thank you, Guy. Now, to a broader lens on the German economy, because German business confidence has risen, but not by as much as expected. The Ifo Business Confidence Index rose to 88.6 in July, up from 88.4 in June. Clemens Fuest, the president of the Ifo Institute, joins us now. Clemens, what is the current health of this German economy? To what extent is sentiment being powered by expectations of a deal with the US?
Good morning. Yes, that's a factor. There is the hope now that there will be a deal with the US and maybe also less uncertainty about how things will be going on, what tariffs will be. So that's one factor. The other factor, of course, is the debt package decided by the German government. So there is the infrastructure fund. That will have an impact. Companies hope they will benefit from that. And there is the investment booster, so incentives, new tax incentives to invest that have been introduced. And we see in the data that investment goods producers are actually showing improved data. So their business situation improves and their expectations are boosted by that. So there seems to be an impact. But this is more domestic factors rather than the tariffs, where there is hope, but also continued uncertainty, of course.
What do you think? What is your best estimate, Clemens, you and the team at the Ifo Institute, in terms of what a 15% tariff deal between Europe and the US, if that's what we get, what that would do for the prospects of the German economy through 2025 and into next year?
It would be something German exporters could live with. So, of course, exports will become more difficult as a result of this compared to the situation last year or before Trump. But, we would avoid a massive negative impact. So I think a 15% deal, which is stable then, would also stabilize the economy and at least wouldn't make prospects worse. We shouldn't forget it's not a very good deal for Europe. But given the threats of much higher tariffs, I think that would be good news. The question, of course, is will this be reliable? But I think it would be an improvement compared to what we had in recent months.
Are we getting closer when it comes to investment decisions from major corporates in Germany? Are we getting closer to a point, if we do get a trade resolution, if we do get a deal where more capex will be put to play? Is there a sense that corporates are keeping dry powder on one side until they get more clarity, and then we get an impulse in terms of capex spend at some point this year into 2026?
Yes, there will be an impact. I mean, we at the moment, as I said, we are seeing a positive impact coming from the change in tax incentives and the prospects of higher infrastructure investment in Germany. Also, the prospect of higher spending on defense. So that's something that's driving capex at the moment. But of course, a deal would help because under this enormous uncertainty, companies have little choice. They have to postpone projects, and I think if that resolves, if that uncertainty disappears, some investment projects will be coming forward. Of course, the question is, does the uncertainty really disappear? How reliable is the U.S. government when they make a deal? That's a question, but I think if there was a deal, it would help.
OK, Clemens Fuest, the president of the IFO Institute, in that modest uptick in terms of sentiment coming through when it comes to the business community of Germany, amidst all those questions, of course, about potential deals between Europe and the US. Clemens, thank you very much indeed, as always, for the context. Coming up, France says it will recognise the state of Palestine, adding to pressure on Israel over the war in Gaza. More on that next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. President Trump says he will not fire the Fed chair as he clashes with Jay Powell and pushes for lower rates during a rare tour of the central bank. The global stock rally hits the brakes as uncertainty over US monetary policy snaps a 7-day winning streak. Plus, tariffs weigh on European earnings. Both VW and Puma cut their outlook as trade concerns mount, but VW shares rebound. Now, French President Emmanuel Macron says France will recognise Palestinian statehood in September. He made the comments as pressure grows on Israel to ease the humanitarian situation in Gaza. Let's bring in Bloomberg Horizons anchor Jemana Pasechi for the details. So, Jemana, Macron saying that France will recognise Palestinian statehood in September of this year. The UK Prime Minister Keir Starmer under pressure from many of his own backbenchers to do the same. Why is this happening now, Jemana?
Yeah, well, the backdrop to all of this, of course, Tom, is that there were hopes that maybe a ceasefire would be agreed to once again between Hamas and the Israeli side. But as we found out in the last 24 hours, negotiations have broken down and the U.S. have fully withdrawn their teams now from Doha. Steve Witkoff, the U.S. Middle East envoy, saying that Hamas are not acting in good faith. So that is the backdrop to this announcement coming through from the French President Emmanuel Macron, saying that they're moving to recognize Palestinian statehood as soon as this September on the sidelines of the UN General Assembly. I should say, though, Tom, in the past year, there have been several European nations who've pushed forward with this, including the likes of Ireland, of Spain, Malta, Norway, and in total right now, there are 147 countries around the world who do recognize Palestinian statehood. There is now also an increasing amount of pressure on the UK Prime Minister to do the same. We know that Keir Starmer will be having a call with his counterparts in Germany and France today to talk about the humanitarian crisis on the ground right now in Gaza, but stopping short, of course, of that full recognition. Now, it is also important to note that the US Secretary of State, Marco Rubio, put up a post on X saying that this is a reckless decision by the French and only serves Hamas propaganda and sets back peace. In addition to that, Israel also commented, the Prime Minister's office, saying, we strongly condemn President Macron's decision to recognize a Palestinian state. Such a move rewards terror and risks creating another Iranian proxy. So this is the latest vis-a-vis Palestinian statehood. But of course, on the ground, There is a dire humanitarian situation with the UN Food Agency warning that 100,000 women and children are suffering from severe acute malnutrition. The Gaza Health Ministry reporting a rise in hunger-related deaths, 33 in the last 48 hours.
Yeah, indeed, it is a dire situation, one that the head of the WHO has described as a man-made situation as well, with mass starvation. I'm quoting from the head of the WHO. And Jemana, this is, of course, having an impact on many people seeing these images, these deeply distressing images out of Gaza. And people are expressing their opinions in the world of finance. And we've seen an example of that today.
Yeah. Yes, absolutely. So you're referring to a situation where the global head of short-term interest trading from Citi, Akshay Singhal, put up a post on LinkedIn with a picture of a starving child alongside a caption. The caption itself was deemed inappropriate and in violation of Citi's policy. A spokesperson said that the social media post by one of our employees that is inconsistent with our code of conduct. The post has been removed, and we are reviewing the matter. The individual in question is currently on paternity leave, unclear what happens to his role. But really, Tom, it speaks to the polarizing nature of this conflict, the extreme difficulty that exists in marrying your political positions with your professional backdrop, your work. And in this situation, it appears to be the case that this individual did violate Citi's code of conduct. That being said, we spoke about this earlier in the week. 25 nations have put a letter and a statement forward, including, we were speaking about it, the likes of France and Canada earlier this week, warning about the very dire humanitarian situation on the ground in Gaza, saying that it is reaching breaking point now. And really, there is a lot of pressure on Israel right now to help alleviate some of those humanitarian strains. Israel, for their part, have said that the 25-country statement that was released earlier this week was disconnected from reality. Hamas is to blame for starting the war and failing to release the hostages. And the reason that the food is not being administered is because it is still under siege by Hamas. So indeed, a very fraught situation still, and one that continues to polarize people all around the globe.
Bloomberg Horizons anchor Jemana Pasechi, thank you for that important update. Now, switching focus, US Treasury Secretary Scott Bessent will meet his Chinese counterparts in Stockholm next week for their third round of trade talks aimed at extending a tariff truce and widening the discussions. Let's bring in Bloomberg's Brussels Bureau Chief Suzanne Lynch with the details. What can we expect then? It seems that there is momentum to these talks between China and the US. What are you and the team watching for?
Yes, well, the fact that Scott Bessent is coming to Europe for that talk early next week is being seen as a positive sign. He himself has said that he expects the truce, if you like, that was agreed back in Geneva in April, for that to be extended. That had been due to expire on August 12th, so we are expecting an extension of some kind. I think the mood music has been quite positive from the United States over the last few weeks vis-à-vis China. There's possibly talk of a summit at some point between President Trump and the Chinese president, maybe by the end of the year. But of course, the US is going to have some asks. For example, this continuing issue about the deficit with China. America wants China to buy more of its goods. Although we have seen some progress on the other issue that has annoyed a lot of manufacturers and indeed the US government, which is exporting of rare earth magnets to the United States from China. And we did see some moves by China to boost those exports. So that's a kind of another positive sign that things are going relatively well at the moment.
OK, relative. It is relative, isn't it, to your point, in terms of that caveat. But we'll watch for those talks next week. Meanwhile, we're going to get talks, maybe some discussion between the UK Prime Minister Keir Starmer and Donald Trump, who's going to be arriving in Scotland this weekend. Can we expect any progress in terms of that UK-US trade deal? It's been signed, of course, but there are a lot of big questions that remain, particularly when it comes to tariffs on steel.
Yes, this is an interesting kind of diplomatic challenge now for the British Prime Minister and the government. Donald Trump is arriving in Scotland later tonight for a personal tour. He's going to be playing some golf, so let's keep an eye out on who may join him on the golf course in Scotland. But yes, the UK has made it clear that it wants more clarity. It wants a deal on the steel element of that trade deal it already signed with the United States. In particular, the US has been requiring or asking that steel has to be melted in the UK to apply to be able to get lower tariffs. But this is proving difficult, particularly for Tata Steel. So the British side are going to want to try and get some agreement on this. It's going to be difficult. They have escaped that 50% tariff, but they want to bring it right down. So we're expecting some kind of meeting between the Prime Minister, Keir Starmer, and the US President on Monday. No press events so far scheduled. Let's see. But they are hoping to make some progress on that early next week.
OK, Brussels Bureau Chief Suzanne Lynch, thank you very much indeed. With what to think about when it comes to the meeting between the UK Prime Minister and his counterpart, of course, President Donald Trump, in Scotland this weekend, and looking ahead to China-US talks next week. Now, a group of 4 traders, meanwhile, will appeal convictions that saw them jailed for fixing benchmark interest rates after the UK Supreme Court overturned, of course, the conviction of Tom Hayes this week. So 4 traders will be appealing those convictions that saw them jailed for fixing benchmark interest rates. We're talking about bankers from Barclays and Deutsche Bank amongst those 4. This, again, is according to the law firm representing them, Hickman and Rose. The 4 were jailed for fixing LIBOR and Euribor, but of course, now we have seen Tom Hayes' own conviction quashed by the Supreme Court, so this legal action continues. Back to the equity markets now, and earnings. Puma shares have plunged after the German sportswear maker slashed its forecast for the year amid weak demand and growing concerns about the impact of US tariffs. The company expects to report a loss in adjusted earnings before interest and taxes this year. Switching focus to what is happening in terms of AI and developments in the healthcare space. In the race to transform healthcare through artificial intelligence, one startup has received a major boost. Clinical tech company Aidoc has secured a $150 million financing round, bringing total funding to $370 million US. The funds will be used to speed up developing an AI model to help physicians with clinical decisions, and it's already having an impact on the ground. Very pleased to say we're joined now by the co-founder and CEO of Aidoc, Elad Walach. Elad, good morning. Thank you for joining us. What does this fundraising round mean for what you and the team are able to do as you push your products out?
Well, Tom, first of all, thank you for having me here. I am extremely excited about this funding round, not just because of what it says to Aidoc, but what it says for the industry as a whole. Our mission in Aidoc is to reduce diagnostic errors and improve quality of care. Each one of us in our lifetime, we will likely suffer from something like a diagnostic error. The Hopkins University published last year a study showing that we have every year in the US alone 800,000 people a year suffering from either a diagnostic error or a permanent disability. You add to that the problems we have with access to care, and really you see that our potential is human. We have to break through with that. And we have amazing physicians, but they need all the help they can get. The power of this raise is really accelerate what AI can bring to the market. The way AI has been developed for clinical care in the past was disease-specific, one at a time. And despite having profound impact for every disease, it was very slow. This foundation model aims to bring a technology that in 3 years will cover practically every relevant disease state that can be identified and support physicians in their care delivery.
Every disease could be covered within 3 years. And look, Elad, you founded this company back in 2016, so well before all the hype around ChatGPT. You're shipping into hospitals in the US right now. Give us a sense of how much demand you're seeing and what it's doing in terms of changing those diagnostic outcomes.
Yeah. So first of all, we're a global company. We're analyzing today over 45 million patients a year. So pretty significant scale, deployed in over 2,000 hospitals. But I want to maybe bring this home with an example of a use case. So pulmonary embolism, to those that don't know, is a blockage in the arteries of the lung. It's a very critical disease. And today, the problem that exists is that we have such massive shortage of physicians that we have huge backlogs of cases that physicians need to read. So for example, if you do a scan of your chest, a chest CT, and you have an unexpected pulmonary embolism, you could be waiting for days, if not weeks, to get your diagnosis. So I want you to imagine the phone call you're going to get, 7 days after you did your study. You actually have something very acute. You should come to the ED right away. Obviously, very deadly and can risk every patient. With this technology, you can basically prioritize this patient and be the physician aide to help them get to the right patients very, very quickly and effectively get them almost real-time results and get them the care that the patients need. Now imagine doing that at global scales for hundreds of millions of patients and now can receive better care.
Elad, what are the biggest roadblocks to scaling this technology? Is it regulatory? Is it adoption? Is it reluctance from physicians? What's holding back greater scale and greater shipping of this product across hospitals?
This is why I'm so excited about this raise, because the problem was actually technological. Physicians love the solutions. If you get it in their hands, they are grateful for every help they can get, and they are really the heroes. Regulation is challenging. Everything has to be FDA cleared and CE marked, but it's possible, and we've been through this a dozen times, and the agencies are collaborative. The problem is that developing something that is clinical grade is so tough and so difficult. It would have taken us, before this foundation model, every disease to cover would have taken us 2 years. And we were probably the company that is fastest in the world in development of these FDA cleared solutions. With this new technology, the foundation model, you can actually develop new diseases in a matter of 1 to 3 weeks. Imagine the potential for us to get to the coverage with this.
What do you do when it comes to questions around data security, privacy, and medical confidentiality? How do you integrate that into your products?
So you have to be very attentive of when you develop these products to all of these problems and more. One of the problems, by the way, that we pay the most attention to is bias. So when you train your models, you have to be develop them an incredibly diverse data set. So our data set is global. And I think there is a recognition that you have to really train on multiple varied patient population in order to ensure that the quality is there. You don't want to create or have AI solutions exacerbating existing biases.
And Elad, in terms of the size and scale of this market, what are you telling your backers? You've just raised, as we said, $150 million US. How big could this be? What is the potential scale of this market longer term for you and the company?
I think this is one of the biggest market potentials in the world. Look, to give you a sense, if we try to quantify in the US alone this problem of 800,000 patients with permanent disability, if you try to quantify that, that is a problem worth anywhere between $500 billion to $1 trillion annually to the US. And that is not even factoring access problems, et cetera, et cetera. It's a massive problem, which is why I am so excited to bring this technology. And by the way, to bring this foundation model to market, we've partnered with the tech Goliaths, with NVIDIA and with Amazon. We're very proud to work with them to foster a whole ecosystem around this because it's such a massive undertaking. No single company can do this alone.
Okay. Elad Walach, thank you very much indeed, the co-founder and CEO of Aidoc, with that raise and the partnership with, as you mentioned, NVIDIA and Amazon as well, with that diagnostic solution powered by AI. Coming up, LVMH shares rebounding this morning after a tepid earnings report. We're going to focus on the sector and look ahead to numbers from Kering and Hermes next week. That is next. This is Bloomberg. Welcome back. So we had the earnings dropping from VW. We've been speaking, Guy Johnson, to the CFO, of course. The company has cut its outlook, but the stock has rebounded. Look at that. The gains coming through for VW, up 3.8%. This could be linked to a comment from the CEO of the business saying that he expects around 15% tariff levels from those EU-US talks. That's according to the CEO, Bloomer, who made that comment at around 8:45 a.m. UK time. We still await, of course, details on that potential trade deal, but it seems that maybe investors are latching on to a view. 15% could be something that this is a company that could weather ultimately. So the stock turning around after being down in the session on the back of that cut to the outlook, now up 3.8%. That's having a ripple effect across the auto space. Mercedes-Benz are jumping 2.2%. As you can see, Stellantis as well up 1.4%. And Renault, which is seen as one of the companies more resilient to the tariff and trade impact, currently up 1.8%. So the whole sector is getting a lift on the back of this. Again, it is expectations around trade and tariffs, it seems, that's fueling the upside for autos. In the luxury spells, LVMH shares rebounding as well this morning, despite a tepid earnings report. You saw sales actually falling more than expected. The numbers crossed towards the end of the day yesterday. Demand for the company's luxury products slumped in China and Japan, key markets, of course, as shoppers held back. Let's bring in Erwan Rambourg now, Global Head of Consumer and Retail Equity Research at HSBC. Erwan, what were your takeaways from the earnings that came through from LVMH?
I think it was quite brutal, to be honest. I think it was a sign that luxury overall is misaligned. You've got macro issues. You've got what we've called greedflation. So this idea that a lot of handbag, notably companies, increase prices way too much, way too quickly. And you have a lack of creativity. But as you said, the stock is up. And it might be a bit counterintuitive. I think the stock is up because the market is basically calling the trough. I think everything that's gone pear-shaped for the past few months is probably not getting worse from here. Traditionally, long-onlys look at valuation. Traditionally, hedge funds look at margins. The reality is the way this sector works is sales momentum. As you said, sales were a miss yesterday, especially on what counts, which is fashion leather. But this might be the trough. What I mean by that is tourism in Europe is terrible, but probably not getting worse. Japan, you alluded to, was collapsing. That collapse is broadly behind us. American consumers are likely now being boosted by equity markets being at all-time highs. And the all-important Chinese are probably doing less bad. They're not rebounding. But as one CEO in the space would say, you can't do minus 25 on minus 25% forever. At some stage, you find a level. The savings ratio in China is very high. The appetite for luxury is still there. They just didn't have the motivation. Hopefully that starts to mend. And so I think what the market is playing now, at least in the short term today, to explain this share price rebound at LVMH is the trough in terms of sales decline.
That's really interesting. What would you need to see? What would investors need to see, do you think, to turn that from a short-term story to a longer-term upside for the stock? Which of those pieces is most important to really lock in?
I think the moment you start to see proper growth again for the sector is when you have both of the important clusters, meaning the American consumer and the Chinese consumer, growing very decently at the same time. And in our assessment at HSBC, that won't happen before Q2 26. As I said, the Chinese are on the mend. They're still declining, but quarter after quarter, less so. The American consumer is doing very well at home, not so much abroad, likely because the euro dollar is a bit curbing the enthusiasm when tourists come to Europe. And remember, you had a sort of post-election bump last year in the US, starting early November 24 and up until Valentine's Day 25. So again, we're seeing the Chinese quarter after quarter doing better. We're seeing the American consumer being involved at home, not abroad. Both might start to grow very decently starting in Q2 26. So if you're a long-term investor, Q2 26 isn't that far away. If you're a hedge fund thinking for the next 2 weeks, wait it out.
What is the assumption? How much is priced in, do you think, more broadly across the sector when it comes to tariffs? Is there an assumption being made by the markets at this point that you get 15%? Is that what's being priced in right now?
I think, it's interesting because tariffs can be relatively easily offset at the P&L level for luxury. Remember, these are essentially retail-heavy companies with gross margins at 70% or above, depending. And so at the P&L level, tariffs are not an issue. Tariffs are an issue very clearly at the psychological level. I believe that indeed we're probably looking at investors thinking anywhere between 10 and 20% we can live with. Very clearly, we're not in a scenario of escalation to 50 and Europe fighting back with retaliation. I think we are in an environment, from what I'm picking up from investors, where we get a resolution between now and the 1st of August.
How much pricing elasticity do you see for the sector into the back end of 2025 and 2026?
So it varies greatly. But as I said, one of the themes right now is greedflation. This idea that a lot of the soft luxury, meaning handbag brands, increased prices way too much post-COVID. I think they increased the prices way too much because in the post-COVID era, people were queuing to buy up your stuff. And so you thought, oh, if they're queuing, presumably I have pricing power. And if they're queuing, presumably they like what they're seeing. You were wrong on both fronts. She was queuing because she had been stuck at home. She was bored out of her mind. She had accumulated some savings and she just needed a breather. But she's not ready to pay up that much. And she certainly doesn't want your existing product. She wants something that's a bit fresh. So again, as I mentioned, this is a handbag issue. There are exceptions. I think Hermès was very reasonable in terms of price increases. I think the hard luxury space, meaning jewelry and watches, were also quite reasonable. And that's why you're seeing an outperformance of Richemont, for example, with Cartier and Van Cleef being reasonable. That's why you're seeing an outperformance of Hermès.
Okay, really smart analysis on this luxury space. We're running short of time, but we appreciate it. Erwan Rambourg, who is Global Head of Consumer and Retail Equity Research at HSBC. Don't forget to catch the latest edition of Bloomberg Next Africa. Meanwhile, this month's show comes from the G20 Finance Ministers meeting in South Africa. The brief is next. This is Bloomberg.